December 30th, 2025. Silver just had one of the most violent days in modern commodity history. And I mean violent, we're talking about a metal that hit an all-time record high of 83.62 per ounce on Monday morning, December 29th. Then, within hours, it collapsed to 73.72, an 11% intraday drop. Peak to trough, 15%. The futures market settled even lower at $70.46, marking the worst day for silver since February 2021. Not days, not weeks, hours. A $4 billion wipeout in leveraged long positions, gone, evaporated, as if someone just pulled the plug on the entire market. And here's what should concern you. This wasn't random. This wasn't just volatility. This was the exact playbook we've seen twice before. 1980, the Hunt brothers. 2011, the post-financial crisis squeeze. And now 2025, same pattern, same mechanisms, same devastating outcome for those who didn't see it coming. In the next half hour, I'm going to show you the 6 precise reasons why silver crashed 11% intraday, with a peak-to-trough drop of 15% on December 29th. Not speculation, not theory. The actual mechanics, the data, the policy decisions, and the market structure that turned a record-breaking rally into a bloodbath. Because understanding what happened on December 29th isn't just about silver. It's about understanding how modern commodity markets work, who controls them, and what happens when paper promises collide with physical reality. Let's start with what actually happened, because the timeline matters. Friday, December 27th. Trading volume is thin. Markets are in the holiday dead zone between Christmas and New Year. London's operating with minimal staff. New York's skeleton crews are watching screens. Liquidity has evaporated. Then, Monday morning, December 29th, Asian markets open. Silver immediately spikes during overnight trading. Within hours, it hit $83.62 per ounce. But then something changes. The selling begins, not gradual profit-taking. Liquidation. Massive sell orders hitting thin markets. Silver drops $2, then $5, then $10. By early afternoon Eastern Time, silver had crashed to $73. 72 is an 11% intraday collapse. The peak to trough move, 15%. Futures markets settle at $70.46, marking the worst day for silver since February 2021. So what happened? Let me show you the 6 reasons. And we're going to start with the one that triggered everything. Reason number 1, CME margin hikes crushed leverage positions. This is where it all begins. The Chicago Mercantile Exchange, CME Group, controls COMEX. COMEX is where silver futures trade, and futures trading runs on leverage. You don't need $100,000 to control $100,000 worth of silver. You put up a fraction, called margin, and borrow the rest. On December 12th, 2024, the CME raised initial margin requirements for silver futures by 10%. Then December 26th, Christmas Day. While most of the Western world was celebrating, the CME issued advisory number 25393. Effective December 29th, margins would increase again. The March 2026 contract went from $22,000 to $25,000. That's a 25% increase from the December 12th level. That's a 53% increase from where margins sat in early November. Now, here's why this matters. Futures traders operate on leverage. Let's say you're running 10 to 1 leverage on a silver position. You control $250,000 worth of silver with $25,000 in margin. When the CME raises margin requirements, you suddenly need more capital. If you don't have it, your broker issues a margin call. You either deposit more cash or they liquidate your position forcibly at whatever price the market will bear. And when hundreds of traders get margin calls simultaneously on a thin liquidity Monday morning, what happens? They all try to sell at once into a market with no buyers. Prices gap down, $5, $10 per ounce. There are no bids, just air. This isn't speculation. Market observers documented exactly this pattern. According to reports from traders on the ground, forced liquidation dominated the price action. Analysts called it a historic move. We haven't seen a move like this in a long time. The liquidity vacuum was so severe that silver plunged 15% peak to trough, the biggest high-to-low change since August 2020, when it dropped 16.085%. Now you might be thinking, why would the CME do this? Why raise margins right when silver is hitting all-time highs? Let me show you the pattern, because this has happened before, twice. In 1980, the Hunt brothers accumulated more than 200 million ounces of silver using leveraged futures contracts. Silver went from 6 per ounce in 1979 to nearly $50 in January 1980. The CME responded by implementing Silver Rule 7, which effectively eliminated leverage. Margins skyrocketed. The Hunt brothers couldn't meet the margin calls. They were forced to liquidate. Silver crashed from $50 to $10 within 2 months. The Hunts went bankrupt. In 2011, silver surged from $8.50 to $50 per ounce, driven by zero interest rates, quantitative easing, and European debt crisis fears. As prices peaked, the CME raised margins 5 times in 9 days. 5 times. Margins went from 4% of notional value, allowing 25 to 1 leverage, to 10%, allowing only 10 to 1 leverage. Forced liquidation triggered a 30% crash in weeks. 2025 follows the exact same script. Silver rallies to all-time highs, leverage reaches extreme levels, CME raises margins, forced liquidation, crash. The playbook hasn't changed in 45 years, but the CME margin hike was just the trigger. The underlying structure was already fragile. Which brings us to reason number 2. Reason number 2, year-end profit-taking and thin liquidity. Let me explain something about commodity markets that most people don't understand. Liquidity is everything. Liquidity is the number of buyers and sellers active in the market at any given time. High liquidity means smooth price movements. Lots of buyers, lots of sellers, transactions happen without big price gaps. Low liquidity means volatility. Small orders move prices dramatically because there aren't enough participants to absorb them. In the last week of December, that's when global liquidity disappears. Think about who trades silver: investment banks, hedge funds, proprietary trading desks, commercial hedgers. They're all staffed by humans who take vacations. The period between Christmas and New Year is when trading desks go dark. Skeleton crews, reduced risk limits, automated systems running on minimal supervision. According to market analysts, the year-end period creates what they call thin market conditions. Michael Hay, head of commodities research at Societe Generale, said directly, "Don't read into massive moves. The end of every year tends to be so illiquid." Silver had gained more than 25% since mid-December. That's a 25% rally in 2 weeks. For traders who bought silver at $60, selling at $82 represents a 36% return in 14 days. That kind of return triggers profit-taking, especially going into year-end when funds want to lock in gains for annual performance reporting. But in normal markets, profit-taking is absorbed by new buyers. In thin December markets, profit-taking overwhelms available liquidity. Sellers dominate. Bid-ask spreads widen from pennies to dollars. When the iShares Silver Trust, the world's largest physically backed silver ETF, fell 10% in its single biggest drop since 2020, that wasn't panic. That was year-end redemptions hitting a market with no liquidity cushion. Now combine low liquidity with forced liquidation from margin calls, and you get what traders call a liquidity vacuum. Prices don't decline smoothly, they teleport. $83 to $73 in hours. No trades in between, just gaps. This is what happened on December 29th. The margin hikes triggered forced selling into the worst possible liquidity environment. But there's a third factor, and this one is psychological. Reason number 3, overbought technical signals and momentum reversal. Let's talk about market psychology for a minute. Because technical analysis matters, not because charts predict the future, but because traders believe they do. And when millions of traders are watching the same indicators, those indicators become self-fulfilling. The Relative Strength Index, RSI, is one of the most widely followed momentum indicators. It measures whether an asset is overbought or oversold. An RSI above 70 is considered overbought. It means too many investors bought too quickly. A pullback is likely. Going into December 29th, silver's RSI was above 70, well above. Some charts showed readings above 80. That's extreme overbought territory. For comparison, an RSI above 70 for more than a few days is rare. Silver had been there for over a week. Gold's RSI was similarly elevated. Both metals were flashing the same technical signal: overbought, overextended, due for a correction. Bloomberg's commodity strategist Mike McGlone had warned about this weeks earlier, saying, "When it gets this stretched, be careful." The most important thing for people like me who have been bullish on gold forever is 2 words: take profits. When technical signals line up with year-end profit-taking and margin hikes, you get a perfect storm. Momentum traders who bought silver simply because it was going up don't have fundamental conviction. They're riding the trend. And when the trend breaks, they exit immediately, no hesitation. That selling amplifies the decline. And here's the reinforcing loop. As prices fall, RSI drops. When RSI crosses back below 70, algorithms interpret that as a momentum shift. They issue sell signals. More selling pressure, prices fall further, RSI drops more. It's a cascade. The momentum reversal on December 29th wasn't just psychological. It was algorithmic. High-frequency trading systems don't care about fundamentals. They react to price patterns. When silver broke key technical support levels, automated systems triggered sell orders. That added fuel to the liquidation fire. But the technical factors wouldn't have mattered if the underlying market structure was sound. Which brings us to reason number 4. And this is where it gets interesting. Reason number 4, the Shanghai premium collapsed, signaling speculative exhaustion. Throughout December, one of the most remarkable dynamics in the silver market was the Shanghai premium. Let me explain what that means. Silver trades globally. The two major pricing centers are COMEX in New York and the Shanghai Gold Exchange in China. Under normal conditions, prices in Shanghai and New York trade within a few cents of each other. Arbitrage keeps them aligned. But in December 2024, that alignment broke down completely. Throughout the month, physical silver on the Shanghai Gold Exchange was trading at massive premiums to COMEX prices. By late December, the Shanghai premium hit over $8 per ounce. Reports indicated prices briefly touched levels where Shanghai was trading 8 to 10 higher than London or New York. An $8 premium is unprecedented. It's not an arbitrage opportunity. It's a market dislocation. It means demand for physical silver in China is so intense that buyers are willing to pay 8 more per ounce than the global paper price. That signals either a physical shortage or speculative mania, or both. But on December 29th, something changed. The Shanghai premium started collapsing. Why? Because Chinese regulators stepped in. China's only pure play silver ETF, the UBS SDIC Silver Futures Fund LOF, had seen its stock market price surge more than 60% above the net asset value of the silver it held. That's insane. It means investors were paying $160 for $100 worth of silver. Pure speculation. On Friday, December 27th, the fund's promoters imposed new restrictions and trading limits. The fund's value dropped by its daily maximum of 10%, ending what the manager called unsustainable gains. When trading adjusted Monday, the speculative froth was breaking. Chinese retail investors, who had driven the frenzy, started pulling back. Social media chatter, which had been full of talk about global silver shortages and supply squeezes, turned cautious. And here's the critical part. When Shanghai premiums collapse, it signals that the marginal buyer, China, is stepping back. China accounts for over 50% of global industrial silver demand. When Chinese buyers pull back, even temporarily, it removes a massive source of price support. The Shanghai premium wasn't just a curiosity, it was a sentiment indicator. When it peaked at $8, it showed extreme demand. When it collapsed on December 29th, it showed that speculative fever was breaking. The market interpreted that as a signal to sell, but the Shanghai premium collapse was itself driven by something bigger, a policy shift that's been building for months. Reason number 5. China's January 1st export restrictions created front-running exhaustion. This is the structural factor that explains why silver rallied so hard in December and why the rally was unsustainable. On October 30th, 2024, China's Ministry of Commerce announced new regulations. Effective January 1st, 2026, companies exporting silver from China would need government licenses. Only large, state-certified producers with annual production capacity of at least 80 tons would qualify. Why does this matter? China controls 60% to 70% of the global refined silver market. China isn't just a major consumer, it's a major refiner and exporter. Approximately 121 million ounces of silver flow out of China annually, mostly through Hong Kong to Western markets. Those exports have been keeping global markets supplied, while industrial demand outpaced mine production. The new export restrictions threatened to choke off that flow. When the announcement hit in late October, silver prices immediately began rising. But the real surge came in December. Why December specifically? Front-running. Chinese exporters knew that after January 1st, 2026, exports would become restricted, so they rushed to ship as much silver as possible before the deadline. In October 2024, China exported over 660 tons of silver. Record volumes flooded into London and New York warehouses. Exporters were front-loading, getting metal out before the restrictions hit. But front-loading creates a problem. You're pulling future supply into the present. That creates a temporary glut followed by a future shortage, and it creates a price pattern. Surge before the restriction, collapse after the flow stops. Western investors saw China's export restrictions as bullish. Reduced supply equals higher prices, right? So they bought it heavily. Silver ETFs saw massive inflows, retail buyers piled in, everyone is positioning for the January 1st supply crunch. But sophisticated traders understood something the retail crowd didn't. The restriction was already priced in. The front-running had created a temporary price spike. Once January 1st passed and the actual restrictions took effect, the reality might be less dramatic than the fear. The buy the rumor, sell the news dynamic. On December 29th, with January 1st just 3 days away, profit takers decided to lock in gains. The China export story had driven silver from $60 to $83 in 3 weeks, a 38% gain. Smart money takes profits on that kind of move before the catalyst actually arrives, because often the anticipation is more powerful than the event itself. But there's one more factor, the 6th reason, and this one ties everything together. Reason number 6. The paper to physical disconnect reached breaking point. This is the deep structural issue underlying everything else. The silver market operates on two levels: physical silver, bars, coins, industrial inventory, and paper silver, futures contracts, ETFs, derivatives. This works fine under normal conditions. Most paper contracts settle in cash, not physical delivery. Traders profit from price movements without ever touching actual metal. But during periods of stress, the disconnect between paper and physical becomes a problem, because you can create infinite paper contracts. But you cannot create infinite physical silver. Throughout December, this disconnect widened dramatically. The Shanghai premium hitting $8 per ounce was one symptom. Another symptom, backwardation in the London silver forward curve. Backwardation means spot prices are higher than future prices. The market is paying you more for silver today than for a promise of silver later. That's abnormal. Normally, futures trade at a premium to spot due to storage and interest costs, a condition called contango. But in December, London silver forward curves went into deep backwardation. Spot silver at $80, futures for delivery in 3 months at $73. The market was screaming that physical silver today is more valuable than a promise of silver tomorrow. Why? Because deliverable physical supply is tight. Industrial buyers need actual metal, not paper contracts. And there isn't enough physical metal available at current prices. Silver lease rates, the cost to borrow physical silver, spiked to 30% annualized in October. That means market participants were so desperate for physical silver that they'd pay 30% interest just to borrow it temporarily. That doesn't happen unless supply is genuinely constrained. COMEX registered inventories, silver available for delivery against futures contracts, fell nearly 70% over 5 years. London Bullion Market Association vaults lost around 40% of their holdings. Shanghai inventories hit decade lows. The drawdown is real. So here's the paradox. Physical markets were showing extreme tightness, shortages, backwardation, high lease rates. But on December 29th, paper prices crashed 11% intraday. How do you reconcile that? Easy. The crash wasn't about physical fundamentals. It was about paper market mechanics. Margin calls force paper liquidation. Thin liquidity amplifies the move. Momentum algorithms pile on. The paper price crashes even though the physical market remains tight. This is the critical insight. Paper markets control short-term price discovery. Physical markets control long-term reality. When paper and physical diverge, short-term volatility increases. That's exactly what happened on December 29th. The paper market crashed, while the physical market remained structurally tight. Now, here's where this gets really interesting. What happened on December 29th isn't the end of the story, it's the middle. Because the fundamental issues driving silver, industrial demand, supply deficits, China export restrictions haven't changed. The crash was a liquidation event driven by leverage, liquidity, and market structure, not a change in fundamentals. Let me show you why this matters going forward. Silver industrial demand reached a record 680 million ounces in 2024, the fourth consecutive record year. Projections indicate industrial consumption will surpass 700 million ounces in 2025, with forecasts reaching 750 million ounces by 2028. Solar panels alone consumed approximately 198 million ounces in 2024. Electric vehicles, electronics, data centers, 5G infrastructure all require silver. These are not discretionary uses. They are embedded in technologies that governments are mandating and subsidizing. But mine production is not keeping pace. Primary silver mines are declining, not expanding. Global silver supply, including both mined silver and recycling, totaled approximately 1.02 billion ounces in 2024. Demand was 1.17 billion ounces. That's a deficit of 149 million ounces for the fourth consecutive year. The 2025 forecast shows another deficit, the fifth straight year. Structural deficit means inventories are being drawn down to fill the gap, and inventories are finite. China's export restrictions, which take effect January 1st, will exacerbate this. Even if exports don't stop entirely, the licensing requirement will slow flows and prioritize domestic use. Western markets that have depended on Chinese refined silver will face tightness. So what does the December 29th crash actually tell us? It tells us that leverage and liquidity matter more than fundamentals in the short term. It tells us that when paper markets are stretched, even minor catalysts, like a margin hike, can trigger violent reversals. It tells us that the gap between paper prices and physical reality is widening, not narrowing. For traders, the lesson is brutal. Leverage kills. If you're trading silver futures on margin and the CME decides to raise requirements, you're at their mercy. Forced liquidation doesn't care about your thesis. It doesn't care if the fundamentals are bullish. It liquidates your position at whatever price clears the market. For investors, the lesson is different. Physical tightness is real. The 5-year supply deficit isn't going away. Industrial demand isn't slowing. But short-term price action will remain volatile as paper markets wrestle with leverage positioning and market structure. The December 29th crash doesn't invalidate the bullish case. It resets positioning, it shakes out weak hands, and it sets up the next leg. Here's the pattern. Silver rallies on fundamentals, leverage builds, margin hikes trigger forced liquidation, prices crash, weak hands exit, strong hands accumulate. Then the rally resumes, driven by the same fundamentals that never changed. We saw this in 1980, we saw it in 2011, we're seeing it now in 2025. The real question isn't why silver crashed 14% in a single day. The real question is what happens next. And to answer that, you need to understand the 6 factors we just walked through. CME margin hikes can trigger short-term liquidation, but they don't create new supply. Year-end thin liquidity amplifies moves, but January brings liquidity back. Technical momentum reversals reset sentiment, but they don't change structural deficits. Shanghai premium collapses signal short-term exhaustion, but Chinese industrial demand hasn't disappeared. China export restrictions might be priced in, but the actual supply impact takes months to fully materialize. And the paper-to-physical disconnect creates volatility, but ultimately physical scarcity wins. The December 29th crash was spectacular, violent, a $4 billion wipeout. But it was also predictable. If you understood market structure, you saw the setup. Extreme leverage, thin liquidity, CME margin hikes. The ingredients for a forced liquidation event were all visible. What's not predictable is the timing of the next move. Silver could consolidate at $70 to $75 for months, or it could resume the rally in weeks. And what is predictable, based on historical patterns, is that structural supply deficits don't resolve quickly. They take years. And during those years, prices trend higher with violent corrections along the way. The Hunt brothers squeezed silver to $50 in 1980 before the crash. It took 31 years, until 2011 for silver to reach $49 again. Then it crashed. It took 14 years until 2024 for silver to finally break above $50. Now it's hit 83. This is not a straight line. It's a series of squeezes, crashes, and consolidations. Each cycle is driven by the same fundamental reality. Demand exceeds supply. The December 29th crash reset the positioning. Leveraged longs got flushed out. Profit takers locked in gains. Momentum traders exited. What's left is the underlying structural tightness. The same tightness that drove prices from $60 to $83 in 3 weeks. That hasn't changed. So here's the takeaway. If you're trading silver on leverage, December 29th was a lesson in risk management. The CME can and will raise margins when they feel the market is overheated. If you're caught on the wrong side with too much leverage, you get liquidated. No exceptions, no mercy. That's the game. If you're investing in silver for structural reasons, physical supply deficits, industrial demand, monetary debasement, December 29th was noise. Painful noise if you bought at $83, but noise nonetheless. The fundamentals that make silver attractive long-term haven't changed. What changed is short-term positioning and sentiment. Those reset. Fundamentals persist. If you're trying to understand commodity markets, December 29th was a masterclass in how paper market mechanics can overwhelm fundamentals in the short term. Margin requirements, liquidity, technical positioning, these factors matter. They can create 11% intraday moves, 15% peak-to-trough crashes that have nothing to do with whether there's enough silver to meet industrial demand. The silver market is at an inflection point. Physical supply is genuinely tight. Industrial demand is rising, but paper markets remain leveraged and volatile. This creates a dynamic where short-term crashes can happen even as long-term fundamentals strengthen. That's uncomfortable for most investors, but it's reality. December 29th, 2025 will be remembered as one of the most violent single-day moves in silver's history, from 83.62 to 73.72 in hours. An 11% intraday crash, 15% peak to trough, futures settling at 70.46. Historic liquidation event, but it won't be remembered as the end of the silver story. It will be remembered as a reset, a liquidation event that cleared out weak hands and excessive leverage, setting the stage for the next phase. The 6 reasons I showed you today, CME margin hikes, thin year-end liquidity, overbought technical signals, Shanghai premium collapse, China export restriction front-running, and the paper-to-physical disconnect, these aren't just explanations for what happened on December 29th. They're a framework for understanding how silver will trade going forward, because these factors will continue to interact. Margin requirements will adjust, liquidity will ebb and flow, sentiment will swing, China's policies will evolve, and the gap between paper and physical will persist. The one constant is the structural supply deficit. That's not going away. Not in 2026, probably not in 2027, maybe not for a decade. As long as industrial demand outpaces mine production, physical silver will remain tight. And as long as physical silver remains tight, prices will trend higher over time, with violent corrections along the way. What happened on December 29th was the correction. Now, what comes next is the resume of the trend. The fundamentals didn't change. The structure is still tight. The deficit is still real. All that changed was positioning, sentiment, and the price you can buy it today versus yesterday. That's the silver market in 2025. Violent, volatile, and structurally bullish. Understanding the 6 reasons why silver crashed 14% in a single day doesn't just explain the past. It prepares you for the future, because this pattern will repeat. Maybe in 3 months, maybe in 3 years, but it will repeat. And those who understand the mechanics will be positioned. Those who don't will be liquidated. December 29th taught us that lesson again. The same lesson was taught in 1980 and 2011. Markets driven by leverage and sentiment can crash violently in the short term, even when fundamentals are bullish long term. The question isn't whether to participate in silver. The question is how, with leverage or without, trading or investing, short term or structural. The crash is over. The liquidation is complete. What happens next depends on how these 6 factors evolve. But one thing is certain. The story isn't finished. It's just getting started.